What's going on YouTube? It's Mo. 90% of the world's millionaires became so through real estate. I'm sure you heard that one before, but how did real estate create so much wealth and so many millionaires?
Welcome to the game of equity, my friends. And in today's video, we're going to tell you what equity really is and how you can use the game of equity to become a millionaire in real estate. Have you ever taken a moment to reflect on what your superhero financial strength is as a healthcare professional? Let me rephrase that. What do you think is the main driving power behind your financial success as a healthcare professional? Go ahead, think about it. Take a second. Just pause the video, but don't go anywhere. Just think about it. No, it's not your charming good looks and personality, although we're sure that helps a lot. It is your earning power as a healthcare provider.
If your goal is to become a millionaire and achieve financial independence by practicing medicine alone, just by saving your income from every paycheck and parking that money in a checking or a savings account, then it's going to take you a very long time to achieve your goal. It's definitely doable, but it's going to take you grinding it out day in and day out for many years. However, if you use your earning power to purchase real estate and build equity along the way, you're going to be able to call your own shots and work as much or as little as you want. You become masters of your own destiny and career just by learning how to control and harness that superpower. And yes, we are superhero nerds. And we often do daydream about a career as Avengers if healthcare or YouTube don't work out.
So what is equity? Well, equity is a financial term that is defined as what you own. In terms of real estate, it is the difference between the fair market value of that property minus the total balances of any debt that you may have on that property. Well, guess what? It's formula time. So equity equals the value of the property and any repairs if applicable minus the mortgage balance. And in order to derive the fair market value of that property, you could study comparables, get advice from an appraiser or a professional licensed real estate agent like myself.
Now, there are many factors that go into the valuation of a property, and the valuation system is not uniform across all properties. For example, 1 to 4 unit properties are valued based on the comparable sales. However, 5 unit plus properties are valued based on the income that those properties produce. With that in mind, the more you learn how to evaluate the property's estimated value for yourself, the more in control of the process you're going to be. And now, the mortgage balance, which is simply how much you plan to borrow for that property or what your current mortgage balance is.
So how does equity translate to dollars, wealth, and riches? Well, not only are we glad you're here, but we're very happy that you asked that question. So let's run through some examples to show you why equity is an important consideration when analyzing your next real estate property deal. Let's say you purchase a property at fair market value of $100,000 and you put $20,000 down as a down payment, 20%, with the remaining balance of $80,000. Well, the equity that you have in that property, the amount that you own, equals your down payment, which is $20,000. And month after month, as you pay down the mortgage balance on that property, your equity in that property will continue to rise.
It seems obvious and pretty straightforward so far. But what if you were able to purchase that same property with a fair market value of $100,000 and you were able to negotiate down 15%? So you were able to pick up that property for $85,000. And to keep things simple, let's assume we're going to be putting that same $20,000 down on that property. Now let's see what that 15% discount does to our equity in that property. So for starters, we would take the $100,000 in value for that property, subtract it from the mortgage balance of $65,000, and just to remind you, our purchase price was $85,000 and we put $20,000 down, and that is why our mortgage balance is $65,000, and that would leave us with $35,000 worth of equity into that property. So in essence, that $20,000 of your own money that you use for your down payment just made you an additional $15,000 right off the bat. And that is a 75% return on your down payment money alone. And that doesn't even factor in the additional equity that you're going to be having each month whenever you pay that mortgage balance. Now do that a few times over and see how quickly your net worth is going to be increasing.
Now that we have your attention, let's see how this equity stuff works in yet another example. But we're going to use the exact same property that we purchased at a 15% discount at $85,000 with $20,000 down. Now, you purchased this property at $85,000, but the fair market value of the property is $100,000. But you notice that it needs a little upgrading. You got to add a little pizzazz to the property, so you do some research. And you find out that other properties, comparables, are selling for about $150,000 with upgraded kitchens and bathrooms. So you decide to put in the work, you throw down the cash, $25,000, and you upgrade that property. Now, after all those upgrades, that property that you initially purchased for $85,000 with $20,000 down is now valued at $150,000. Now, the equity that you have in that property is based on the new valuation of $150,000 with a remaining mortgage balance of $65,000, bringing our total to $85,000. Now, that's not even the full story. Remember, you put down initially $45,000 of your own money into this property, $20,000 down payment, and another $25,000 for upgrades. That $45,000 got you back $65,000. That's a 144% return on your money. And every month that you pay down that mortgage balance on that property, the equity continues to climb. The amount that you own continues to rise. I mean, holy shit. No wonder we love real estate so much.
So we keep on mentioning that with each mortgage payment, your equity in that property increases. But let's dive a little bit deeper to see what that looks like. So let's take that $65,000 loan and let's assume that it's a 30-year fixed loan at a 4% interest rate. So by year 10, as long as you keep continuing to make those payments, your mortgage balance is going to be down to $51,000. And by year 20, it's going to be down to $30,000. And by year 30, you own the property free and clear. You own nothing on that property. And all the equity you have in that property just translates to more wealth for you. Also, over time, your equity in that property also increases when the property appreciates to the tune of 2 to 3% annually to keep up with inflation. Now, 2 to 3% return annually might not sound like a lot to some people, but whenever it's compounded over a long period of time, it does generate a lot of wealth. Now, let me show you an example of that. Let's take that last property that we did an example on that's now valued at $150,000 once we completed all the repairs on that property. And let's take the lower of those two numbers of 2% appreciation year after year. So by year 10, at a 2% appreciation, that property is now worth $183,000. And by year 20, it's valued at $223,000. Not bad for a property that you put down $45,000 on to acquire and upgrade. It's like the gift that keeps on giving.
Now, before you get all excited and decide to jump in with both feet first into real estate investing, keep in mind that real estate cycles do exist and they present with ups and downs in the market, and future valuations may become fuzzy at best because things do change and will change, and real estate is no exception to that rule. This is why you should focus on the immediate equity of that property by purchasing it at a discount and forced appreciation of that property via improvements on that property, rather than trying to predict the future appreciation value of that property.
Now that you know how to figure out and analyze the current and future equity you have in a property, don't forget to add it to your toolbox when analyzing your next deal.
And always remember, account for the income that property is producing, as we showed you in the past couple of videos. But more importantly, don't forget to hit that subscribe button and the like button, and we'll see you next time.